Record. Chapter 17. In this chapter, we're going to discuss investment and business brokerage. We're talking about a lot of investor lingo, I'm sorry. So in this chapter, we're going to explain advantages and disadvantages of investing in real estate. We're going to describe the tax benefits of real estate investments and the effects of the New Jersey Uniform Commercial Code, which regulates the sale of businesses. It's a different UCC. We learned about UCC, Uniform Construction Code, and we're also going to learn more about that again in next chapter, 18, that talks about subdivisions. We're going to go over it once again. But in this chapter, it's a different UCC, the Uniform Commercial Code, which regulates the sale of businesses. So in this chapter, we're going to talk about a lot of different investment lingo. All right. And to start there, we're going to talk about what are some of the advantages and disadvantages of investing in real estate. Well, the advantages are to generate some sort of return on your investment, right? Any investor is seeking a return on their investment. They want to make money on their money. That's the whole purpose of investing, right? So real estate's no different. Leverage is using someone else's money to do it. You talk to any rich person, they never use their own money. They always use someone else's money, even if they're taking a loan. Why risk your own money when you could risk someone else's, right? So leverage is using borrowed money, using someone else's money, and hoping that the values go up enough that by the time you sell the property, you could pay back the money you borrowed plus any interest and make a tidy profit for yourself. That's called leverage. So using inflation as a hedge. So as property values go up with the market, because real estate markets are cyclical, they go up, they go down. Property values go up, they go down. So if you hold on to property long enough, the value will go up, and you sell it in the upswing when the value is up. So that's using inflation to your advantage. You did nothing to the property. You just waited for the value to go up before you sold it. And now you're using inflation as a hedge to make your profits. Okay. That's what using inflation as a hedge is. Now, some of the disadvantages of investing using real estate as your investment tool is it's not highly liquid, meaning you can't sell it quickly without taking some sort of a loss. Unlike stocks and bonds, where you could buy them in the morning and sell them in the afternoon because they appreciated and you can make money, right? Real estate does not appreciate that quickly. It takes a lot of time before it appreciates. You could kind of rush that process a little bit by forcing an appreciation by doing improvements. But generally speaking, you're not going to buy real estate at the beginning of the week and sell it at the end of the week for a profit. Because real estate doesn't just appreciate naturally on its own that way. So it's not highly liquid. That's what that term means. Liquidity means the cash is flowing. It's easy to get the cash back. Now, it does require a lot of expert legal and tax information. And there's a high level of risk, especially if you don't know what you're doing. So let's do the highlights now that say the same.
I'm good.
Okay, everybody got that? So
Yeah.
there's real estate as the investment. Did somebody say something? They didn't get it? You want me to go back?
No, got it.
Okay, okay. So the ways of real estate investment can yield a return. Well, property can be held for appreciation. You're using inflation as that hedge. It's generally expected to increase in value and to show a profit when the home is sold at some time in the future. You could hold on to the property as income property for producing income while you're holding it by collecting rents, as well as the profit on the eventual sale. Cash flow is a term that means spendable income. You want that cash flowing. Cash flow is spendable income after expenses. We're also going to learn here about pyramiding through refinancing. This is you could buy real estate using, let's just say, an FHA loan. Or if you're a veteran, a VA loan that requires, FHA loan only requires 3.5% down. VA loan requires no money down for the veterans. Or if you're buying property in rural areas, you could get loans uh, through the USDA, right? 100% financing. And there's a lot of different ways that sources where you could get cheap money. Okay. So you can buy yourself a four-family house starting out, right? Renting out the other three units, you're living in one of them, building up that equity. And then you refinance out of that as you build up that equity into a conventional loan after you already have the property. You could now refinance. It's easier to refinance a property you already own rather than initially getting financing for a property to buy. So you could refinance, take the cash out, and then rent out the unit you were living in that four family and use that. So you're refinancing out of an FHA or other loan program to a conventional loan, taking the cash out equity and then using that as your down payment now, using another FHA loan to buy another property. If you keep doing this, rinsing and repeating, um, you know, you could find yourself owning millions of dollars of property in a rather short period of time simply by pyramiding. However, all of your properties are going to be highly mortgaged because you keep draining all the equity out if you continually keep doing this. However, if you stop doing it at some point, that equity is going to continue coming. The money is going to keep coming in from your rents, and you're using it to pay down the value of the property, building even more equity. So that's what pyramiding through refinancing is. The only downfall to it is all your assets are highly mortgaged until you stop doing it, and you just hold on to the properties you have and collect the rents and you start using that equity to pay down the debt. So what is equity? Equity is the difference between the market value of the property and what is owed on it. So equity is the difference between the market value and what is owed on the property. And there's three different ways that you could build equity through just market values fluctuating, through paying down your debt. Usually your equity is equal to your down payment at the time you purchase the property, because that's the difference between the market value and what's owed on it. You put some money down, so your equity is usually equal to your down payment when you first buy a property. And then you can also build equity by doing improvements on the property, increasing its value that way. So cash flow is spendable income after expenses. So let's highlight that on page 328. Cash flow is spendable income after expenses.
Done.
Yes, got it.
All right. Trying to stay ahead of the class with the notes here while we're going over things. Okay. So, some tax breaks for homeowners. You can get tax breaks from the sale of your primary residence. What is a primary residence? It's the house you live in. We should always refer queries when people ask us questions to their accountants, their tax attorneys, or CPAs. But both the federal and state governments have exclusions from capital gains tax on the profit of the sale of your primary residence if you owned and occupied that property for 2 out of the last 5 years. Now, single filers are entitled to a $250,000 capital gains tax exclusion. Married couples filing their taxes jointly are entitled to a $500,000 capital gains tax exclusion from the profit of the sale of their primary residence. What does that mean? That means if you're married and you file your taxes jointly, you could sell your primary residence for up to a $500,000 profit and pay absolutely zero state or federal income taxes on that profit from the sale of your primary residence. However, you have to live in that home for at least 2 out of the last 5 years before selling. And the IRS may allow deductions if you were forced to sell any sooner than that due to perhaps a hardship. Some examples that the IRS considers as a hardship would be a job loss or transfer. So you're forced to, you're forced to sell because your job is you lost your job, or they're relocating you. So job loss or transfer that would force the sale of that home. Health reasons, death, divorce, or multiple births. The IRS sees all these things as a hardship that they could still get their tax breaks if you were forced to sell early due to one of these reasons. You could use this deduction as often as every 2 years for another property. You just needed to live in it for at least 2 out of the last 5 years. So you can reuse this deduction over and over and over again, as long as you lived in the property for at least 2 out of the last 5 years as your primary residence. So remember, sellers must pay income taxes on the profit from the sale of an investment property, but not for their primary residence. Investment properties are different. Commercial properties, you got to pay taxes on the income from those investments. However, if you do have an investment property, there's a way that you could avoid it, at least temporarily, for quite a while. If you sell a property that you bought as an investment property and you cash it out and you get that profit, and you profit from the sale of your property, you can reinvest that money in purchasing another investment property and not have to pay the taxes that on the income from the sale of that investment property, the first investment property. So you have an investment property, you sell it at a profit. You normally have to pay income taxes on that profit, state and federal income tax. It's a capital gain. You pay capital gains taxes. So if you were to reinvest that money in buying another 1 or 2 investment properties, you don't have to pay the taxes on the income from the sale of that first investment property that you made, because you reinvested it into another like-kind investment. That's what the IRS calls it, a like-kind investment, or a deferred exchange. It's called a 1031 section. They call it a 1031 exchange because it's from section 1031 of the IRS tax code. So write 1031 above the word exchanges there on page 329, and then do all these highlights. But we're going to go over these details, explaining them a little bit more on the next slide once you got them down. So get those details down, and we'll get into it momentarily.
I'm good.
Yeah, got it.
Okay. So a 1031 exchange. Here, let me give, this is my breakdown of it. The book gives a breakdown. You just got to read a lot more to understand it. A 1031 exchange allows an investor to defer paying income taxes immediately on the profit of their sale of their investment property if they reinvest it in another similar like-kind investment property. They wouldn't have to pay income taxes until they eventually cash out the money and put it in their pocket to realize that gain. That's when you would need to actually pay the tax. When you pull out that profit, you realize, they call that realizing the gain. So strict timelines must be followed to qualify to do this tax deferred exchange. We as real estate agents have to understand this. If we have clients or investors, they're selling an investment property and they want to do a 1031 exchange, you need to be aware there are strict timelines that the IRS requires that investor to follow. Otherwise, they could lose the opportunity to defer the taxable, paying the taxes on that gain. So it's extremely important for the real estate agent to be aware of this. Oh, sorry about that. So it's extremely important for the real estate agent to be aware of this and to know that there's those strict timelines that needed to be followed. And we need to make sure that they have their tax professional in place that could help them communicate with the IRS, their attorney or tax professional that would help them do the communication with the IRS. And we need to be able to help them find another property within a certain time frame, make an offer on it, and close on it within a certain time frame. Otherwise, they lose that tax deferment, and they would have to pay taxes on the income from that sold investment property. So this is the way it works. You tell them to get a tax attorney or CPA to communicate with the IRS, so you don't have to be doing that. And then you must notify the IRS that they'll be doing an exchange at the time of the sale of the current investment property. Then the IRS will give the investor 45 days to find and identify a replacement property that they want to purchase after selling their first investment parcel, or their first investment property. Why do I got parcel written there? First, after selling the first property. They change that in my notes too. That's wrong. And then so they have 45 days to find another property that they want to purchase as another investment property. And then they have a total of 180 days to close on that purchase. Now, it's not 180 days, does not include that 45 days to search for a property plus 180 days. they give you 180 days total to do this whole entire process. Within 45 days, you have to find and identify the property you want to purchase. And within 180 days of the sale of the first investment property, they need to close on this next investment property that they're purchasing. So it's 180 days total. So is when the replacement property costs less than the sold investment property. The difference in value is known as boot. And boot is loot, and all loot is taxable. It is your capital gain. You guys like this explanation a little bit better? Is this a little bit clearer? Let me just see if I can clarify number 3.
Yeah.
The IRS gives the investor 45 days to find a replacement property to purchase after selling the first property, and a total of 180 days to close on that purchase. Not 45 days plus 180 days, but rather 180 days total. I should write the word total there. From the sale of the investment property to complete the transaction. Otherwise, they can lose the tax deferment. Go back to my notes and update them with that new definition. Oh, all right. Boop, 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 boop. So, capital gains and the cost. Capital gain is taxable profit on the investment. A basis is the investor's initial cost for the real estate. So right now we're just learning this investment lingo that investors use. Doesn't matter if it's real estate or some other investment. This is the kind of talk, the lingo that they use when you're running around with in the investment circles of investors. Okay. They use these terms: capital gains, the basis, the adjusted basis. But what do these terms actually mean? So a capital gain is a taxable profit on the investment. A basis is the investor's initial cost for the real estate, for that, whatever it is that they invested in. If we're talking about real estate, it's their initial cost for any investment. And the adjusted basis is the basis plus improvements minus claimed depreciation. So it is the base price of whatever it cost you to buy the real estate, plus any additional money you dumped into it to do improvements, for example. However, to subtract depreciation to get tax, you're allowed to depreciate the value of the investment. You could deduct it on your taxes. So we're going to go over how to do that in the coming slide. So the adjusted basis is the difference between the adjusted basis of the property and all the money you have into the basis and all the money you have in it and its selling price. And then you only pay income taxes on that. So when you're how do we calculate a capital gain? Capital gain is taxable profit on an investment. So you buy a property, you dump more money into it to do improvements, and then you sell it. Is all of that money profit? No. You got to subtract the money that you used to purchase and then fix it up. And then whatever is left over, so you can subtract that money from your sale price, because that's your money that you put in initially to invest. That's not income. That's the money you laid out. So you could subtract that from your sales price, and then whatever's left over, that's your gain. And that's the amount that's taxable. Okay, so the adjusted basis is the basis plus improvements minus claimed depreciation. It's the difference between the adjusted basis of the property, all the money you have in it, and its selling price. And then you only pay income taxes on that, because that's your capital gain. So you guys have the highlights there?
Yes.
Now, I'm not going to start getting deep into percentages and all that stuff, because tax law is always changing, and we're always going to we're not going to be just telling people how this affects their taxes. I'm going to tell them to seek advice from your accountant, tax attorney, or your CPA, right? Because we're not the tax experts. We're not expected to be. However, we are expected to know who those tax experts are. Remember that video that I showed you yesterday from that real estate attorney? She was giving advice why most real estate agents fail out of the business. And one of the things is, you need to know, don't play the expert. You don't need to be the expert in everything. However, you do need to know who the experts are, and you need to refer people to the experts. So you don't also stay quiet either. So don't go putting your neck on a chopping block pretending to be an expert in something you are not. And then again, don't just not say anything. Refer people to the experts. Know who the experts are that could give them the advice for the information they seek. All right, so this is how the 1031 exchange actually works. And what boot is. So when doing a 1031 exchange, and all the replacement property cost less than the sold investment property, the difference is boot. And boot is loot, and all loot is taxable. So you take the basis, that's your initial cost to buy the real estate, was $300,000 in this example. You add the improvements, you dumped another $100,000 in to fix up the property. So your all-in total is $400,000. Everybody following me so far? That's called your adjusted basis.
Yeah.
Everybody with me?
Yes.
Okay. So now
Yeah.
you come around, you're all in this $400,000 on this property. And then you turn around and you sell it for $600,000. So you got $200,000 profit there, right? So
Yeah.
if the property appreciates and sells for $600,000, then there's a $200,000 taxable gain, the capital gain. If you were to reinvest it all in another income property, you would defer paying any of that tax on a 1031 exchange. However, you need to file paperwork at the IRS at every stage of this, letting them know where you are in that you're going to do a 1031 exchange and where you are in that process. I would say leave that to the attorneys or tax professional to do that for this investor. So if you were just to cash out that entire $200,000, put it in your pocket, you got to pay income taxes on $200,000. However, if you were to reinvest it all, you pay no tax because you reinvested it all. Now, if you sell it for $600,000 and then you buy another investment property, but that investment property only cost $500,000, you're actually cashing out a $100,000 from that gain that you're not reinvesting in a new investment property. So that $100,000 is taxable. That's called boot. When this boot is the difference in price from the investment property to the replacement property. That extra money is called boot. And boot is loot, and all loot is taxable. That's your capital gain. Any questions on that, or does everybody understand my example there?
Yeah, it's quite
No,
simple.
it's good.
Yeah.
Okay, let me just get my Snagit tool out so I can get a screenshot of this and put that to our notes. Or the notes I'm making for you guys anyway. Oh. And all right. So depreciation. We learned that depreciation is a loss of value due to any cause or any condition is known as depreciation. However, in this instance, we're going to refer to depreciation as an accounting concept where you can make deductions on your taxes for the cost of the investment. So depreciation is an accounting concept to deduct the cost of an investment to purchase an investment property. You can deduct those costs of the investment and any improvements on the investment property for taxation purposes. This is not lower the value of your property. This is just deducting the money you put into it, into purchasing this investment property. Now, you could deduct that on your taxes, not all at once, but over the lifetime of the asset's useful life. So it's not this, when we talk about depreciation here, it's not a reflection of the actual loss of value of the property. It's used to reduce taxable income before taxes are computed. A property's value cannot be depreciated or deducted all at once. The asset has to be depreciated over a period of years, whatever its life expectancy is as defined by the IRS. The value of the land cannot be deducted. Why? Because land does not depreciate, except in extreme circumstances. Now, the IRS, you'll see this when they talk about depreciation as an accounting concept on a question on exams, they'll refer to it as the economic lifespan of an improvement. That's what the IRS calls it anyway. So what is the economic lifespan of the improvement of residential property? It is 27 and a half years. And on commercial property, it's 39 years. So whatever money you put in to buy the property and fix it up, you could deduct that over a period of 27.5 years on residential property as the investment, or 39 years on commercial property. That's what the IRS estimates the asset's useful life. So you can't make the deduction all at once. It's kind of like if you have a business and you buy machinery or equipment or a vehicle for that business. You cannot deduct the entire cost to purchase that expensive equipment all at once. However, you can depreciate it over a period of years of whatever that asset's useful life is. For vehicles, I believe the IRS has it at 7 years. So it has to be whatever it costs to buy a truck for your a plumber buys a van for their business, right? So whatever the cost is for that van, they could divide that cost by 7, and that's how much they could deduct each year for the next 7 years of that asset's useful life against the income on their taxes, reducing their taxable income. Everybody following me on that?
Yeah, I got it.
Yeah,
So the same thing applies with real estate, though. However, real estate's a lot more expensive, and it has a longer lifespan, economic lifespan. So whatever the value of that residential property is, divided by 27.5 years, and you could reduce your taxable income. You could deduct that amount on your taxes each year for the next 27 and a half years, or 39 years if it's a commercial property. Okay. So let's highlight this, and I want you to write next to the title in the book where it says depreciation, economic lifespan of an improvement, because that's the type of jargon, that's the type of lingo that they're going to use on exams. This is at the bottom of page 330. And continuing on to, this is continuing on page 331 here. That's that same explanation that I gave on the previous slide.
Okay, I'm good.
yeah, got it.
I'm sorry, got muted there. Okay, so when you file your taxes every year, you buy a house. The cost to buy that house, you could divide that by 27.5, and whatever the value of the improvement is, not the land, because land cannot be depreciated. You know how your tax, you get tax bill and for your property, and you see value of the land, the value of the improvement, total value. Okay, so you need to separate it out that way. You need to figure out what the value of the improvement is and then divide it by 27 and a half years, not the total purchase price of that property, because land does not depreciate. So you need to figure out how much the value of it is. Here's a sample question that they give you on exam, and it's worded like this. If a property's estimated value is $500,000 and the land is estimated at $150,000, how much would be depreciated over 3 years if the asset has an economic lifespan of 27.5 years? That's the way they word the question on exam. Now, the next slide is, I show you how to work it out, but can anybody here try to figure it out right now without me getting to that next slide yet? Let's see if you guys can figure that out.
Like 500,000 divided by 27.5.
Uh-huh.
And then whatever price we get, that's like for 1 year. So we do it for 3 years then.
Yep. So basically, I don't know why this animation goes all on its own. Each step was supposed to go on a click, and then it goes to the next slide all on its own. Let me back it up. I broke this slide somehow. I don't know how the hell I did it, but I got to try to figure out how to fix it. Anyway, here's the example. If here's that question, this is how you solve it. You take the total property value is 500,000. The land value is estimated at 150,000. So you got to subtract the value of the land from the total property value to get the value of the improvement of $350,000. Now you could divide that by 27.5 years, the economic lifespan of the improvement. And that gives you $12,727.27 you could deduct on against your income each year to lower your taxable income. And then you calculate your taxes based on that lower income amount. Now, the question here said, how much would it depreciate over 3 years? So you take that figure and you times it by 3 to get the answer. $38,181.82 is how much you depreciated over 3 years already. You had the property for 3 years, you depreciated each year for your taxes. But how much can you deduct? How much can you lower your income? So if your income is $100,000 a year, you subtract $12,727.27 from it, and whatever that amount is, 80 something thousand, you can now you calculate your taxes based on that amount. That's how you figure out this problem. So if anybody wants to snap a picture, be my guest. I'm going to do it too, because I'm going to add it to your notes. You could, if I could find that pesky little, there we go. Screenshot taker. Come on, screenshot taker. There we go.
So like I had just like to clarify,
Uh-huh.
like if the land never depreciates, but like the item, like whatever we build on it, that's what actually with time wear and tear and all.
That's the improvement. So yeah, improvements can depreciate, but land does not. That is correct.
Okay. And for commercial, we just do the same thing, and it's just like 39 years.
Yep. Commercial, it's the same thing. It's just that you do it based on 39 years. That is 100% correct.
Okay.
Okay. So deductions in federal tax laws. So the federal tax law limits the deductibility of losses from rental income from rental property. The first $25,000 of loss can be used to offset income from any source. The investor must actively participate in the management and operation of the property. They call this sweat equity, because you're doing work on your own property. Instead of hiring a landscaper, you cut the grass, things of that nature. And then you do some work like that. You put in sweat equity, then you could take that additional $25,000 deduction on your taxes from any source of income. So if you have income less than $100,000 before the deduction is made, though. I don't believe you need to know that for exams. I don't know why they tell you that, because we're not like the tax experts, but who the hell knows what they put on exams these days? Maybe you could let me know, and then we'll find out. But I'll add that to your notes anyway. Because we're not tax experts. We're not expected to. So a tax credit is
Yeah,
a...
just,
Yeah, go ahead.
to clarify, like if we have a rental property, we can actually put in like around up to 25,000 as for repairs or something, or damage to the property or something.
Well, hold on. Now, this is the first 25,000 of loss can be used to offset income from any source. Yes. So basically, you got a rental property, and you need to replace the water heater and the furnace or whatever, or you need to replace the roof on there. the first $25,000 of loss can be used to offset income from any source. So you could deduct that on your taxes. As long as your income is less than $100,000.
Okay, okay, got it.
What would apply if your income was over 100,000 or what have you? Or if you have any other questions about that, you always refer people to their accountants
Yeah,
because we're not expected to be the tax experts.
yeah.
We're expected to know who they are, who to refer people to, but we're not expected to be the experts in everything. So,
Right.
because there's so many agents, they try to be so helpful when they get started in this business, and and I understand that. I was the same way, but you got to realize that you're not expected to be the expert in everything. So this is not a business where you fake it till you make it. That's the type of situation that'll land you in lawsuits, where somebody's going to sue you because you gave them wrong advice or it ended up costing them. So let's highlight a tax credit is a direct reduction in taxes due rather than deductions from income before the tax is computed. So we just learned how to reduce your income before tax is computed. However, a tax credit is a lot better than a tax deduction. It's worth a lot more. So they give an example here. For investors in older buildings and do renovations or in low-income housing projects may use tax credits to offset tax up to $25,000 of other income. Even passive investors can take advantage of this credit. The maximum income level at which the credit can be taken is also higher. Investors with adjusted gross incomes up to $200,000 are entitled to the full $25,000 offset, which is reduced by 50 cents for every additional dollar of income and eliminated entirely if your income is $250,000. So there we go. There's that additional information if you're making more than $100,000. Okay. So tax credits have been provided for taxpayers who renovate historic properties. A historic property is one that's is designated by the Department of the Interior and listed in the National Register as a historic landmark or a property of historic significance located in a state certified historic section of town, the historic district. This allowable credit is 20% of the money spent on the renovation. The work must be accomplished in accordance with federal historic property guidelines and certified by the Department of Interior. After renovation, the property must be used as a place of business or rented. It cannot be used as a personal residence of the person taking the tax credit. See, this is pretty interesting. So this is only really for historic properties that are being used as commercial properties. And that's interesting. You guys familiar with Metuchen?
Yes.
You guys know that whole downtown area over there? That's all those old historic properties. There's a huge area there for blocks and blocks. It's all historic properties, but they're all commercial businesses being run out of them. Okay. There's one lady, one family that owns all of those properties. Okay. It's their business complex. And they got all old properties there. The city, the municipality, is trying to force her to upgrade those properties and build newer ones. But the thing is, she gets a lot of tax credits for every one of those properties. She could get 20% of her money for any renovations that she does. So why tear them down and put up new construction where you may not get all that? So, the mayor in town was trying to finagle and say what she can and can't do to her own properties now and putting in all kinds of restrictions. I warned the mayor of the town already that if he does this, you better be careful because it could backfire on you, because she could end up suing the municipality if you restrict her too much on what she could do on her properties now. She could sue the municipality and claim inverse condemnation. Do you guys remember that term? Inverse condemnation? It's when the government puts so many regulations in place that you can't use your property for the intended purpose anymore, and they basically devalue it. So you could sue them for that devaluation of the property that's caused by their over-regulations. So there is a credit of 10% of rehabilitation costs for non-historic buildings placed in service before 1936. I don't know how that would be non-historic before 1936, you know? What's it? Historic is anything, what, over 20 years old? 25 years? Something like that? Anyway, the non-historic buildings must be non-residential property. The law also provides tax credits ranging from 4% to 9% each year over a 10-year period for expenditures on new construction or renovations of certain low-income housing as well. Okay, just some interesting information there for us on tax credits. I got to take that and put it in our notes just for the heck of it. Yeah, we're about to take lunch in a moment too. I know we're around that time. Didn't look at my clock yet, but I'm sure we're around that time. Okay, so let's take a look at the tax credits. Tax reductions versus tax credits. Coming on the next one? Okay. Tax credits. I got to get this one down first. You know what? We're actually going to have a little discussion on this one. So maybe we should do this one after lunch.
Okay.
So yeah, let's do that. So it's 12:25. Wow, 12:25 now. Okay, so let me pause. All right, all. So tax credit is a direct reduction in taxes due rather than a deduction from income before tax is computed. So what is a tax credit? It's a direct reduction in taxes due. So it's more valuable than a tax deduction, because a tax deduction, you reduce your taxable income before you calculate your taxes. A tax credit is a dollar per dollar matching thing, and it's more valuable. And I'm going to do the math on it, and I'm going to show you an example to show that. Now, taxpayers who renovate historic properties or non-historic commercial buildings placed in service before 1936, they get those tax credits, and we read about that on a previous slide. Here, sometimes government offers a tax credit as a stimulus. during our mortgage market crash, the real estate market crash 2006, in all of the a lot of this can be traced back to the politicians as being the cause of it. I already spoke to you guys about that. And in all of their arrogance, politicians stepped forward yet again, thinking they had the solution to stop the market correction from the artificial inflation that they created to begin with. So they offered a tax credit as a stimulus that in 2008, if you rushed out to buy a house, they would give you a $7,500 tax credit to buy a house. And then they offered another one for $11,000 after that initial $7,500 tax credit expired. So they offered these tax credits between 2008 to 2010. That if you rushed out, you could get a tax credit between $7,500 and $11,000, depending when. I think 2008 into, it was like mid 2008 into mid 2009 was the $7,500 tax credit, and then mid 2009 to 2010 it was that $11,000 tax credit. If you rushed out to buy a house, they figured that, hey, if we bribe people, we'll give them a tax credit to rush out and buy a house. It's going to stop the curve. Since we're all so familiar with the COVID curves, we should be familiar about how this works, right? So you know how the real estate market curve, the property values were going up, 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 up. Then the market started to crash. So the curve was correcting itself. The markets were coming down. So they figured that if they get enough people to rush out and buy homes, we could flatten that curve. Now, those stimuluses did flatten the curve, but only temporarily and not totally flattened. Property values were still falling and dropping. Now, when they offered these stimulus, there was a little catch to it. This was offered to anyone who rushed out to buy a home during this time period, with a stipulation that you must live in the home for at least 3 years, or you'll be subjected to pay all that money back that they give you a credit for to the IRS immediately. So some people who did this and then did short sales to get out of these properties before those 3 years were up, not only did they manage to, they were thanking God they finally got out of the foreclosure. They avoided foreclosure by doing a short sale. And then the IRS came knocking on their door and they said, you owe us money. I know we didn't send you any money, but we gave you a tax credit. So the tax credit was money that you then have to pay us. So now you owe us that money plus interest. We want it all paid now. So did the politicians actually cure a problem? Or did they lengthen the time of the correction of the markets by flattening out that curve for a while until the property values started dropping again, and then pulled more people in that previously weren't in financial hardships related to the real estate? They pulled them in by enticing them to come out and buy a house and get a tax credit if they did. And then property values start dropping. People got spooked. They sold. They did short sales. They lost money, and then they had to owe more money to the IRS. So seems like politicians made the problem bigger and worse than it was before. Now, a movie called The Big Short was released, which talked about what led to the housing market inflation and crash, but not so much. They didn't talk about the recovery or any of that stuff. So let's see how the tax deduction versus a tax credit works. So once again, the tax credit is a direct reduction in taxes due rather than calculating a deduction from income tax before the tax is computed. So here's how you would compare a $15,000 tax deduction versus a $15,000 tax credit. Sounds like they're the same, $15,000, right? So we're going to base it off of somebody with $100,000 income that's working in a 15% tax bracket so that you can see the real difference. So here we go. A tax deduction. If you've got $100,000 income and you get a $15,000 tax deduction, you subtract the $15,000 from your income, and then that leaves you with $85,000 of income that's taxable. So now we calculate your taxes based on that reduced income. So if you're in that 15% tax bracket, you times that by 15%, and now you owe $12,750 in income taxes. Okay, so let's see how the tax credit works. Well, that same $100,000 income is calculated. You first calculate your taxes before the tax credit is computed. So 100,000 times that 15% tax bracket you're in, that's $15,000 in income taxes owed. And then you get a tax credit of $15,000. You now owe nothing. You see how a tax credit is much more valuable than a tax deduction? All right. You don't need to know how to calculate this for exams or nothing. This is just an example that I put together to show you guys the value of how much more valuable a tax credit is than a tax deduction. So let's continue. We learned about land contracts that are also known as installment sales contracts in several chapters, actually. In chapter 11 is where we actually mainly hit it, where we went, oh my gosh, thunder is crazy. The skies are crazy out right now. That's a scary sounding storm. You guys hear that outside? I hope we don't get disconnected. All right, so the land contract is also known as an installment sales contract, and that is the type of seller financing where the buyer makes payments in installments and they wait for the deed. The owner does not turn over the deed to the buyer until they paid off the full amount owed or some other amount that they could have agreed upon. And then at that point, they turn over the deed to the buyer. So that's known as an installment sales contract or a land contract. All right, so let's look at a real estate investment syndicate. We learned about business structures, and we learned that a syndicate and a joint venture are not formally created business entities. You don't need to register them with the state and to pay fees to create a real estate investment syndicate or a joint venture, because a syndicate is just a joining together of two people. They come together to carry out a business project. That's like you or I, we get together, we decide, hey, we're going to buy this piece of real estate. We're going to fix up this property, and then we're going to flip it, and then we're going to share in the profits. So we're going to do this together. All right. That's a syndicate. That's an example of a syndicate. Two or more people coming together, carry out a business project. When the project is done, the syndicate is done. And a joint venture is similar to that in that it's not a legally created business entity, but instead of two or more people coming together to carry out the business project, it's two or more groups that come together to carry out a business project. And when the project is done, the joint venture is done. Now, a real estate investment syndicate is a business venture in which a group of people pool their resources to own and or develop a particular piece of real estate. That's like the group of little old ladies hanging around the kitchen table that pooled their money together to buy an apartment building that they're going to rent out so that they could make money. They're now going to be real estate moguls. Okay, that's an example of a real estate investment syndicate. Okay. Yeah. So there's a little warning here for you guys as real estate agents. You may be working with all these people, these investors, and they're looking for a certain type of property to invest in, and you're there looking for it according to their criteria, and you're going to help them out. And after a while, you start to be able to get that eagle eye that the investor has, that you could spot a good investment a real estate investment a mile away. So you come up with this idea, hey, I could find these properties. Why don't I just buy them myself? And I could just do this myself. Oh, yeah, I don't got the money for it. So how could I do this? Because I got this eagle eye. I could spot these properties like these investors want, and I'm making them all this money, but I could be making money like that. But I just don't have the money to invest. But if I maybe advertise and market to the public to try to get them to invest in a real estate project that I will own, how would you try to convince somebody to invest in a real estate project that you own? How are you going to sell that to somebody? Why would anybody want to invest in a real estate project that you own? How would you sell that to them? Why would they want to invest in a project that you own and they don't?
I was thinking like if they're also gonna gain something out of it too, but
Yeah, exactly. There's got to be something in it for them, right?
yeah.
So what kind of promises would you be making to people if it's a property that you own? What are you going to offer them?
Gonna offer them part of the share or like offer them more deals.
Well, we're offering deals. We're talking about you being an investor, buying a investment like an apartment building or something, right? Or a strip mall. And you want people to invest in your project or a bunch of homes being built. And you're gonna own this project. So what are you going to offer them in return? Money, right? A percentage maybe of the profits, perhaps. But they're not going to be the owner, you will be. So you're telling them about all the possible upsides of how much money they could make. You're offering them the percentage of the profits if they invest in your project. You got to be careful because this can be classified as a security, and to deal in securities, you need to have special licensing. Now, any securities that are offered to the public have to include a prospectus. A prospectus is basically a disclosure booklet that's put together by people with special licensing to deal in securities. So they know that you have to register that security with the SEC and the state of New Jersey. You have to put together a prospectus that discloses to people not just the possible upsides of the profits that they could possibly earn, but also all the possible risks that are involved. So they calculate risk. And now these people can make a more informed decision, especially if they're not savvy in investing in real estate stuff. Now, if you don't do any of this and you just get ads out there and you get people to invest in your real estate project that you own, and and it's not registered as a security, and by chance they lose money on it, you could get in big trouble for that. So dealing in securities without the proper licensing. So this could be classified as a security, and you could get into trouble, especially if the investors are not familiar with real estate investing and they lose money. So special licensing is required to deal in securities. The investment must be registered with the FTC and the SEC and the Securities and Exchange Commission, the Federal Trade Commission, and the state of New Jersey under the Blue Sky laws, which regulate these things. Such offerings must have a prospectus prepared warning the investors of the possible risks involved with the investment, not just the potential upside of the profits. Okay, that's just a warning so that you're aware. You guys can do this if you want to, but just make sure that you're aware you need to have someone with the proper licensing to deal in securities to team up with you on this. Otherwise, you risk not just breaking the law, but you also risk other people's money, and that could end up costing you a lot, especially if they lose out. You could end up in jail for that. That's like Bernie Madoff type stuff, if you guys remember that guy, soliciting people's money for investment projects that he owned. And it turned out to be a big Ponzi scheme. He didn't even have these projects to begin with. But that's why you need to have these things registered with the FTC, SEC, and the state of New Jersey, these securities. All right. So we also went over the structure of business partnerships, right? You remember the structure of business partnerships and how that worked? We have general partnerships and limited partnerships. In a general partnership, all members share equally in the managerial decisions, share equally the profits and losses so that they can be held liable for any additional debts that the business takes on. So all members are general partners. See, all members share equally in managerial. Okay, so all members are general partners that work in the day-to-day business activities. In a limited partnership, there's always at least one general partner who organizes and operates business and is responsible for the entire syndicate and any additional debts that the business takes on. Others are merely investors. I'm not going to write syndicate in there. Who organize and operate business and is responsible for any additional debts that the business takes on. Others are merely investors called limited partners. They're limited in their liability to the extent of their initial investment which is all they could risk losing. They're not responsible for any additional debts the business takes on. They don't know anything. They don't work in the day-to-day activities in the business that are not involved in the day-to-day business activities of running the business. They are called limited partners. Limited in their liability to the extent, there we go. That sky has got a nonstop grumbling and rumbling outside right now. Tells me a storm is brewing. Okay, REITs, real estate investment trusts. Real estate investors take advantage of the same tax benefits as mutual fund investors. To create a REIT, there has to be at least 100 investors, and at least 75% of the trust income must come from real estate as the investment vehicle. I believe you have already something like this highlighted about this stuff,
Yes, I do.
right? So let's talk about business opportunity sales now, selling a business. Do you need to have a real estate license to sell a business?
No.
No, you do not, unless real estate's involved. So you don't need a real estate license to sell a business unless real estate is involved. And then you do. So, a lease or real estate sales contract needs to be transferred or negotiated, but that stuff needs to be prepared by an attorney anyway, because what kind of real estate are we talking about when we're dealing with businesses? Commercial properties, right? And we cannot prepare the sales contracts for commercial properties. However, we can market them and try to sell the business and the commercial property. Now, besides title to the real estate or a present lease, an attorney would be needed to prepare the sales or lease contract and the contracts to transfer other business assets like the trade fixtures, stock and inventory, business name, customer list, goodwill, or special rights such as copyrights, patents, franchises, and licenses like Picket lottery machines, etc. So let me move that over. Boom, put that in the notes as well. And so when financing the purchase of a business, substantial down payment is usually required, and seller providing a purchase money mortgage for the balance of the selling price of the real estate if you don't have all the money that is to buy into it. The business purchase requires cash or a personal loan to purchase a business. Right? You're not going to get a mortgage loan to buy into a business. So let's highlight the Bulk Transfer Act is designed to protect the sellers, and write the word sellers there, creditors, from fraud perpetrated by a business owner who sells the business, including equipment and stock, and then disappears, leaving the creditors unpaid. So we need to know this about the Bulk Transfer Act. The Bulk Transfer Act is a section within the Uniform Commercial Code which regulates the sale and transfer of business personal property. All right. So the Bulk Transfer Act, it was put into place to protect those who are offering credits to business, like the somebody who may be supplying the machinery without it being paid up front. You're making payments to the creditors, or maybe they supply the goods, the inventory to stock your shelves, and then you pay them as you sell the items. You pay them off. So this law, the Bulk Transfer Act, is put into place to prevent a business owner from selling the business and saying all the equipment and inventory is included when they have not paid it off yet. They don't own it. So basically, they sell the business with all the stuff that they don't really own, saying it's all included in the sale, and then they leave their creditors high and dry and unpaid. It's fraud. It's fraud to do this. Okay, so this goes over the details. The purchaser should require the seller to prepare a list of existing creditors. The parties to the transaction should prepare a list of all real and personal property that's included in the sale. The purchaser should preserve the seller's list of creditors for at least 6 months after the date of the sale, in case some of them have not been paid, and they can chase after the seller for fraud. So this is just going over all the details of this, but you guys have this line highlighted. We're going to have this stuff on another slide.
Yes, I do.
Okay.
Yes.
So here we go. The UCCs, the Bulk Transfer Act. Regulates business sales. So UCC is the Uniform Commercial Code. And it regulates those sales, those business sales. So the Bulk Transfer Act is designed to protect the seller's creditors. Ooh. Thunder, I could hear the rain, and the thunder is getting much, much louder. So that means the storm is getting closer. Hope it doesn't knock us out here. So the Bulk Transfer Act is designed to protect the business seller's creditors in the sale of a business. It also protects the buyers, but just as a side effect, because they should be informed that the inventory and machinery and tools and chattel have not yet been paid for in full. The seller should never tell them that that everything is included when they have not paid it off yet, because if they did, that would constitute fraud. Especially if they don't pay off those creditors. So the Bulk Transfer Act, the requirements of the Bulk Transfer Act are designed to protect the interests of the buyer as well as those of the seller's creditors in the sale of a business. But mainly the seller's creditors. It protects the buyers kind of like as a side effect. It's like homeowners insurance. Who does homeowners insurance protect?
The property. Well,
In case they can't pay the mortgage, then
Who does homeowners insurance protect? I still haven't heard that answer. Who?
from
What?
fire and all,
They're all-
like unforeseen circumstances that happen in the home.
The question is who? Who? The person. Who? Who does the homeowners insurance protect? Yeah, we know if there's an accident or a fire or something, insurance kicks in, but who does it protect?
the ones under the policy. The
The
policy.
mortgagee, the
Tell it to me in a dumbed down, plain, simple way that I could understand it. Who does it protect? Homeowners insurance.
Wow. Policy owner.
Are you required to have homeowners insurance?
Well, they make it sound like a requirement.
Okay,
So-
hold on a second. If you buy cash, do you need to have homeowners insurance? Do you own a property?
No.
Do you need homeowners insurance?
no.
No. So who requires you to get homeowners insurance?
From whom we take the mortgage,
Why?
so that they are secured, in case anything happens, they get there.
Exactly, because the property serves as security or collateral for the loan. So who do you think it protects?
it protects them.
It protects the lender.
The
Yeah,
lender.
the lender, yeah.
Lender. It protects the homeowner as well, but as a side effect. Its main thing is to protect the lender against loss in the event of an accident, fire, flood, what have you. Their collateral is secured. Now, eventually, as that house gets paid off and you own it outright, you could still carry homeowners insurance, which will basically now cover the homeowner and protect the homeowner. But otherwise, it protects the lender. So in the same way, the Bulk Transfer Act protects the interest of the seller's creditors, at least until they're paid off, right? It also protects the buyer of the business, because the buyer of the business purchasing this business thinking everything's included, and then they find out later they need to pay the bills for these things because they have not been paid off yet. They don't own them. The seller never had the right to just give them to you. So this Bulk Transfer Act protects both the seller's creditors as well as the buyer of the business.
Who are the sellers, creditors, like?
Okay, so who are the seller's creditors? Let me see if we go over that here. Yeah, you know what? Let's read this slide and it should give you the answer. So here's what you need to know for exams. The Bulk Transfer Act is this is my rundown of those rules. The Bulk Transfer Act is in part of the UCC, the Uniform Commercial Code, that prevents fraud in the sale of a business chattel. Chattel is tangible personal property, right? It protects the business seller's creditors from the seller selling the business and its inventory and equipment, saying that it is included in the sale, but it's not yet been paid for in full. So the creditors are whoever gave that business the equipment, whether it is computers or machinery and inventory. Could be a candy store. All the candy on the shelves has not been paid for yet. The bread and the milk that they've stocked in the fridge, the milk, that's not been paid for yet. Right? So they give it on credit. And then as the convenience store sells these things, you know, periodically somebody from the creditors, the ones who stock the shelves with all these candies and the milk and all that stuff and the bread, they come back, they do inventory. Okay, let's see. How much of this stuff rotted? Okay, we got to throw that away. We're not going to charge you for that. How much of the candies and milks and breads have you sold? Okay, well, that's how much you owe us, right? So the business creditors, you ask, who are they? They're the ones that stock the shelves. They're the ones that give you the equipment that you need to run your business that you did not pay for in full. You're making periodic payments until they're paid off, or you're being charged for them once those items are sold. So you can't just say, hey, we're including it in the sales price. All that stuff is paid off. It's owned by us outright. And so therefore, you get it. It's included in the sale. We're throwing it in. So you're buying it and your price seems justified to purchase this business, thinking all that stuff is included in the sale. And so when you sell it, it's all going to be profit, only to find out later that no, you got to pay those creditors because you don't own that stuff on the shelves, that inventory or that machinery. You still need to pay them for it, right?
Yes.
So it really depends on your business, who the creditors are and what it was that they gave you on credit. So then the seller leaves those creditors unpaid. That's fraud. So the Bulk Transfer Act, which is Article 6 of the Uniform Commercial Code, which regulates the sale of businesses, it regulates the transfer of chattel when selling a business. It prevents fraud when the business is sold. The things in yellow you really need to know. It requires the business seller to make a list of all outstanding debts to creditors and supply that list to potential buyers, and then notify the creditors that the business is for sale. And the real estate licensees must ensure these disclosures are made to avoid assisting the seller commit that fraud. So if you're helping them sell their business and you're there saying, hey, yeah, all this stuff is included in the sale, didn't you help them commit a crime to sell their business and say that all the stuff was included in the sale when they didn't have the right to sell it? You helped them commit a crime. Fraud. Fraud's a crime. So in New Jersey, the Bulk Transfer Act protects the seller's creditors. It also protects the buyers and their creditors, but as a side effect. Non-compliance is a criminal offense. So if an agent helps the seller perpetrate the fraud in the business sale, they can be held liable for helping them commit that crime. So real estate brokers may not draw up contracts for commercial property or business transfers. That's practicing the law without a license. And only an attorney can handle these things. So, can you help somebody sell a business? Absolutely. But when you do that, you got to get the seller to make a full disclosure of what is included in the sale and has been paid, or what's included in the sale, and if it's been paid off and owed free and clear, and to make a list of all outstanding debts to creditors that have not been paid off yet, that you still need to pay off, and then make that list available to potential buyers. And you have to notify the creditors of the seller's business that the business is for sale, so they're aware of potential issues to keep an eye on. And that concludes chapter 17. Yay. So let's do the key terms to review for chapter 17. There's only one, I believe. Nope, there are two.
Yeah, two.
Okay, so cost plus improvements minus depreciation. Key terms 1. Cost plus improvements minus depreciation.
Adjusted base.
Adjusted basis.
The adjusted basis. The cost for the property or the business plus any improvements minus depreciation, those are all considered part of the adjusted basis. Increase in value.
Appreciation.
2 is B. Initial cost of real estate. An investor's initial cost for whatever it is that they're investing in. In this case, real estate. What do we call that?
Basis.
Yeah, the basis. It's the base price, the basis. 3 is C. A document transferring ownership of personal property. How do we transfer the ownership of real estate? By a deed. How do we transfer the ownership of personal property?
Bill of sale.
Bill of sale. 4 is D. You guys starting to see a pattern here? They forgot to mix up the answer, the question, the term. So this is the answers are straight down the road for at least for the first key terms here. So extra money of property received by one party in an exchange. What do we call that?
Capital gain?
No, come on. The answers are straight down. They didn't even bother mixing them up.
Boo.
Loot is loot and all loot is taxable. So 5 is E. A law regulating sale and financing of business personal property. What is that law called? We just went over it.
The Bulk Transfer Act.
Transfer Act.
Transfer Act. 6 is F. Taxable profit on the difference between the adjusted basis and the net selling price of an asset.
That is capital gain.
Capital gain is taxable profit. 7 is G. Money left from rental income after expenses are paid.
That's cash flow.
8 is H, cash flow. 9 is I. It's a horrible definition, so we're not even going to go over it because it is absolutely horrible. Tax deferred mutual transfers of income property.
Exchange.
An exchange. And we learned about 1031 exchange, right?
Yep.
10 is J. Real estate held for rental income. Real estate held for
Property.
income property. 11 is K. All right. Law regulating the transfer of business personal property.
Law regulating transfer of business personal property.
Yeah, what's the Bulk Transfer Act a part of a bigger law? What is that bigger law called?
Uniform Commercial Code.
Yeah, the UCC, the Uniform Commercial Code. 10 is A. Refinancing property to buy more. Refinancing property to buy more.
Leverage.
Not leverage. It's called pyramiding.
Pyramid.
I think somebody got their speakers in front of their microphone or too close, and that's why you're getting that little feedback there. Direct deduction from income tax due.
Direct deduction.
What do we call it? A deduction from income tax due.
Marginal tax rate.
No,
The tax credit.
the tax credit. 9 is C. Joining together of 2 or more people to carry out a business project.
Syndicate.
It's a syndicate. 8 is D. A group pooling resources to back real estate.
Real estate.
You little old ladies that put their money together to buy that apartment building.
Real estate investment syndicate.
Yep. 5 is E, the real estate investment syndicate. Rate at which the investor's top dollar is taxed.
Marginal tax rate.
3 is F. Sale in which a seller receives the purchase price over a period of years.
Return. No.
What do we call a type of sale in which a seller receives the purchase price over a period of years? They actually don't even turn over the deed until the full amount is paid.
Installment sale.
Installment sales contract, which is also referred to as a land contract, right? 1 is G. Extensive use of borrowed money for purchases.
Leverage.
2 is H, leverage. A fund making real estate investments and selling shares.
Real estate investment. No.
Yeah, keep reading it.
Oh, yeah, real estate investments trust.
Yep, real estate investment trust, the REIT. 6 is I. And cash flow plus income tax savings plus appreciation. These are all examples of
Return.
a
Return.
return on your investment. Correct. 7 is J. And that concludes chapter 13.